What to do when the market corrects. Picture this. You're sitting at your desk feeling pretty good about your investments. You've been watching your portfolio grow steadily, thinking, this investing thing, easy money. Then suddenly, bam! The market drops faster than your phone battery at 1%. Now what? Sell everything? Blame your broker? Or play it smart? Let's talk about what really works when the market corrects. When the market corrects, it's natural to feel a pang of panic. But here's the truth. Market corrections are normal. They're not some apocalyptic event. They're a regular part of investing, like plot twists in a Netflix drama. And just like in a good drama, you have a choice. Freak out, or follow the storyline to the end. Let me tell you a quick story. In 2008, during the financial crisis, people panicked and dumped their stocks left and right. But a handful of investors, people like Warren Buffett, saw it differently. Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." While everyone else was running for the exits, he went shopping. Fast forward a few years, those who stayed in the market or invested wisely during the downturn made a killing. What's the takeaway? Panic is the enemy of profit. When you see red in the market, don't let it cloud your judgment. Instead, do this. First, hit pause on your emotions. It's easy to let fear dictate your decisions, but investing is a long game. Corrections are just part of the ride. The market has been through wars, recessions, pandemics, you name it. And guess what? It's always bounced back. Next, analyze your portfolio. This is where you separate the winners from the pretenders. Are the companies you've invested in fundamentally strong? Do they have good leadership, solid earnings, and a competitive edge? If the answer is yes, don't sweat the short-term dips. If the answer is no, well, maybe it's time to say goodbye to the underperformers. Now, here's the fun part. Corrections are like Black Friday for investors. Imagine walking into a store and finding everything you wanted at half price. That's what a market correction is. Quality stocks and ETFs that were overpriced yesterday might be on sale today. But remember, don't just buy because it's cheap. Do your homework. Look for value, not just a discount. Let's talk about strategy. Dollar cost averaging is your best friend during corrections. Here's how it works. Instead of dumping all your money into the market at once, you invest a fixed amount at regular intervals. This way, you spread out your risk and take advantage of lower prices when the market dips. It's the ultimate slow and steady wins the race approach. Still not convinced? Let me share another story. During the COVID-19 crash in 2020, the market dropped like a rock in March. People panicked. Headlines screamed doom and gloom. But by the end of the year, the market had not only recovered, it had reached new highs. Those who stayed invested or bought during the dip, they reaped the rewards. And what if you're already fully invested? Hold the line. Selling during a correction locks in losses and shuts the door on potential recovery. Historically, the market has always bounced back, so patience is your best strategy. Here's a tip that often gets overlooked. Diversify. Corrections hit different sectors in different ways. If you're too concentrated in one area, you're vulnerable. A balanced portfolio with a mix of stocks, bonds, and other assets can cushion the blow. Finally, remember this. Your mindset matters. Investing isn't about avoiding corrections. It's about understanding them. Think of them as a stress test for your portfolio and your patience. Every dip is a reminder to focus on your long-term goals and not get caught up in short-term noise. Because here's the truth. Corrections are temporary, but wealth is built over time. The market rewards those who stick with it, who keep learning, and who see opportunity where others see chaos. So the next time the market corrects, don't panic, plan. Because the difference between losing and winning isn't what the market does, it's what you do.